Hi, I'm Paige Steers. I'm here at the MBA conference in Atlanta, bringing you expert insights, and I am with Frank Lenine of Quadrant. And Frank, Jones Lang LaSalle did a survey. They looked at the 136 opinions from lenders, who 34% of them said they're going to put out more capital in 2012. Can we expect Quadrant to also follow suit, put up more money this year?
Absolutely, Paige. I think that that's a common theme. We put out platform-wide a little over $1 billion last year. Our largest client, a big U.S. Life insurance company, did a hair under $1 billion. They're telling us they want to double it this year, and they want to double the size of their portfolio, mortgage portfolio, going forward over the next 5 years. So definitely seems to be a consistent theme.
It is that's good news for borrowers. They want
Good news for borrowers.
They want to hear things like that. So let's look at Quadrant, because you've got a lot of opportunities at your behest, being a diversified investment company. So what are you looking at in terms of regions, areas that look most attractive to you now?
Well, we have a couple of different platforms. We basically, in our shop, break it down into two buckets of money. We have the large U.S. Life Co. that wants to be in the same markets that everybody wants to be, the major gateway markets, the major property types, the big borrowers, the bigger core assets. But then we also have some smaller pension fund money, some offshore money that has hired us to seek sort of opportunities that can attract a little bit more yield. We like those markets, but we're also willing to go to maybe some smaller markets, some smaller assets, something that's got a little bit more structure or a little bit further up the capital stack to try to get the yield, not without necessarily taking on significant, in our minds, significant additional risk.
That's what I was going to ask you. Does that risk get into, some of the hair things, some of the secondary product types? Not that far?
Not that far. I mean, we pretty much stay in the main product types that we've always have, and with our other major clients, but we're willing to go up the capital stack a little bit more. We're willing to do things like forward fundings, structured earnouts, additional advances down the road, that sort of thing. All of which, but fundamentally good assets that we can believe in and we can sleep at night, where we can try to get a little bit extra yield and get the money deployed.
Okay, sounds good. You got some creativity in the approach, which will be another good piece of news for borrowers. They like to see that unconventional thinking. So this is good. So in terms of what we're looking at for the overall economy, Frank, you've got big goals. What are the biggest obstacles you see for the market? Is it interest rates? Is it the economy? What do you see really that could prevent this big surge in what we hope is going to be more capital into the lending environment in 2012?
Well, I think clearly, the market uncertainty has been in the U.S. economy, and then of course the European economy, and that's created a lot of uncertainty, which will affect interest rates. It's going to affect the macro economy. It's going to affect everybody's outlook on real estate. I think coming out of the recession we just came out of, and I'm speaking largely from our life company clients, they're seeing that it wasn't as bad as everybody thought it was going to be going in. They're seeing that from a capital treatment perspective, risk-based capital and the like, that they weren't as impacted negatively as they all thought they would. And now, compared to other asset classes and compared to the pricing, they're seeing mortgages as being an attractive place to be. So what could happen in the future? I mean, could be anything. But if interest rates, well, from a lender's perspective, they're too low. But at these low interest rates, it certainly helps make deals underwrite. But a big significant increase in rates, which will be, of course, driven by an economic shock or something happening offshore. There's clearly a lot of risk. We're seeing, really, I think the capital markets probably driving more the strength we're seeing in the real estate markets. Not necessarily as much fundamentals, although we're seeing the job growth and we're seeing the demand pick up. It doesn't seem to be going at the same rate as the demand from the capital side is driving it.
So capital markets ahead of the fundamentals. We've seen that over the last year. Yeah, we've seen it before. We've seen it a lot last year. So we'll keep watching that in 2012. Thanks for sharing your insights with us, Frank.
Absolutely. My pleasure.